Welcome back. We have been discussing the process of resolution of stressed companies with Mrs. Bhattacharya, the chairman of State Bank of India, and Sanjay Nayar, country head KKR, and of course at the moment speaking for a lot of foreign funds who could be interested in the stressed asset resolution in India. Well, Mrs. Bhattacharya, you spoke about the funds. Foreign capital is one source of funds. We heard a lot about banks getting together and putting in a fund. The governor said that in the press conference after the credit policy that he wouldn't like such a fund to be majority owned by banks. How do you see this stressed asset fund in India?
Actually, we had suggested something where we thought that we could put in 51% and some other player, maybe NIIF or some other player, could put in 49%. The regulator feels that we should not have majority, which is perfectly fine with us. We are willing to not be the majority at all. We gave that proposal because we found that nobody else was going to come forth as quickly as we could, because we are the real affected parties. So that was the reason, but I don't think that's going to be a deal breaker. We are perfectly comfortable coming in with much lower amounts, and we'll see as we go forward how it can be done.
Okay. In your conversations, Mr. Bhattacharya, who else do you think could be interested? Because when our colleagues spoke to government officials just a couple of days back, the interest of putting in NIIF money into the stressed asset seemed to have receded in government quarters. So if government is not going to put any money, just for an assumption, will you still be able to get, say, a few thousand crores from the banks, and will you have enough foreign and Indian capital interested in this fund?
Yes, I think so. I don't think there will be any difficulty. We should be able to do it. And as for NIIF, I don't think they said that they are not interested, because the terms of their reference include stressed assets. I think what was the thinking is that they should go first with a fund that looks at greenfield, because there is a need today to kickstart the investment cycle. And so rightfully, I think they were thinking that greenfield should have priority, and stressed could come later. So it's not a question that they don't want to do it. It's just the, the order in which they would like to do it.
Okay. Sanjay, how much money do you think can such funds attract, both foreign and Indian?
I think it's hard to guess that. I think...
no, for starters, you think a 10,000 crore fund can be put together with banks and privates?
I think a couple of $1 billion should not be a problem. I agree with Mr. Bhattacharya if we start small and experiment with various structures. But I want to just come back to the point of having the government funds with banks being as part promoters. I mean, that's one way of doing it, which I think obviously makes it a little, conflicted. And again, you have an issue of not having true price discovery. That's my sense.
No, actually, I was going to bring that point, that only government and bank fund may perhaps be conflicted, and it will be better if there are private parties in that.
The other one, which I just want to float out there is, and I'm not saying I'm a champion for that, if we have to go through all of this, what if the RBI could let the banks recognize the hit? And I know they've already got a stick and carrot approach, and they've been quite constructive. What about letting them take the hit up to the fair value? Give them another 2-3 years, because the real issue is that there is lack of capital. Then you avoid all of this and you go straight to that method. You have true external capital coming in, marked down to fair value. Banks get a couple of years to write down. And then we can talk of structures where the banks can also benefit if there is an equity upside.
There are already companies which are viable probably if they are given a lease of life, but which have had to be declared NPAs because of the AQR process that the Reserve Bank set in. I would assume that banks will be wary of giving them further working capital and even capex help. How are these companies to be tackled? I understand that there is a program, there is a talking underway to separate sustainable and unsustainable debt, to convert the unsustainable debt in such a way that both banks and promoters take a hit. What are the ideas that banks and companies can work with?
Well, I think you have already laid it out as to what we are thinking, and what Sanjay said is a proposal we have already made to the regulator. So it is not something that the regulators are not aware of. The industry has already made such a proposal to them. The regulators are obviously going to look at it very, very closely to see how it could be acceptable. They had allowed this when the ARC sales were happening, if you remember. They had allowed 8 quarters for any hit that was taken in respect of ARC sales to be written down. So something similar on the same lines could be considered for these as well. And you are right, actually the reason why the banks started these discussions and really picked up the pace was because it's important to be able to give working capital to completed units or give the last mile funding. Once you have classified accounts, it's very, very difficult for the banks to get it through their boards. Especially the smaller banks find it very difficult. And obviously, you know, if you're giving working capital in driblets, then it's a much worse thing than not giving it to them at all. So therefore, there has to be a structure outside of the banks that can look at these stressed assets that can be turned around. And one of the things when we are talking about these funds, etc., one of the jobs that we believe that these funds could do is actually bring in that amount of money that is required for a working capital or some kind of last mile funding required to do the completion of the project. Now this could be in the form of equity, it could be in the form of some kind of a hybrid instrument, or it could be plain debt as well. So it could be a priority debt. So all of these things are there and all of these things are getting considered. Hopefully we'll find our way through this.
If you could elaborate, how can this division be done? Can it be done? There is always a fear, I mean that's what I got from bankers yesterday, a fear that promoters will put too much of their debt in the unsustainable bucket because it will be to their advantage. How can this process be made robust?
No, again, I don't think it's up to the promoters to determine what can be done and what cannot be done. These will have to be based on studies and realistic assumptions, and the studies would obviously have to be done by experts. As you know, when we do anything in our bank, we have a TEV study done by an expert company. Thereafter, we have a panel of experts who actually re-vet that thing to see that, you know, everything that has been done is in order. So it will have to go through a process obviously, and the process itself could be vetted to understand that it has been taken through the right kind of process, and that will determine, you know, as to what should be converted into some kind of other instrument and what could be retained as debt. The idea is that whatever is retained as debt should be immediately serviceable. So I think that itself will give us some pointers, but it need not be something that is immediately serviceable today. We can make out very clearly what could be, you know, the accretion to the EBITDA as the working capital is given and the capacity utilization goes up. So based on that, we can work out what is the amount that is serviceable immediately, and that amount can be retained as debt.
Okay. Sanjay?
In the middle, and let's say that funds do agree to the value at which it is marked. Then the second question becomes that all of this gets transferred in the form of debt. So the whole sizing of the capital structure is the second issue. If all of this becomes as debt, then any new money that the funds are putting in for working capital, I agree with Ms. Bhattacharya, they're just putting in, you know, 10 crores of dribbling working capital doesn't help. But let's say the funds bring in 1,000 crores and really fix all the working capital issues and make sure the plants run, so that at least we can realize the value, gain the market share, get the EBITDA going. The question then is, all this new money that came in, you know, if it's below the debt of the banks, and the banks need to be serviced minimum, let's say 10% on the interest, then this amount of debt, because the capital structure has been fully is like 100-0 debt equity, you know, this becomes inferior to that. So I think our request really is, and we've looked at a few deals, and I think it's being approached very constructively. We're saying only, at least for this new debt, okay, we may not get a super senior structure, even if we are pari passu, then can we at least get serviced government rate plus 2-3%, and that's something like, let's say, whatever, 10-12%. I tell you, foreign funds will come in. If you have to meet in the middle at this marked value of the asset, bring in new capital, I think the equity sharing is pretty easy. We want to control the destiny. The banks don't mind that because we'll bring in experts, we'll work with the management if necessary. and then create equity value which we can then split 50-50. I think this is one way to get started. I think we're getting to a point where a couple of assets we will all try. But I want to assure you that if some of these get done, I think this can really get going. For those assets which can be resolved, EBITDA can be recovered, and they can repay their debt, which obviously will get restructured. Our debt, which is going to be in a way pari passu. And hopefully we can create some equity value which we can split 50-50.
Funds that both of you are talking about, are they near at hand? Because you can't keep ongoing projects waiting for too long. So are we really talking about providing working capital only from outside, not from the banks themselves, because the banks don't want to touch it? And these funds, how quickly do you think it can be put together?
I think patience is the only way we'll get there. Let's not, become too worried about how things will happen. Things will happen.
I was just trying to get an idea, since, Sanjay was speaking about deals, whether we should expect this kind of activity sometime soon. Say, within a quarter, should we have some structures in so that some of the stressed assets the debt would be restructured?
No, I think I told you, 60 to 90 days is what we are giving ourselves. Let's hope that we can do it within that period.
Okay. Will the system also ensure the new restructuring plan that bankers and RBI are talking about, to ensure that promoters sell their more robust assets, their probably personal wealth? Can it be ensured that they will give personal guarantees so that, you get the assurance that they also pay for their miscalculations?
See, if you ask about personal guarantees for everything, then it's not going to happen. Then, the concept of limited liability itself has to be given up. And people will not have that risk-taking ability. That unless there is a problem in the account, or unless the promoter wants to keep trying and keep taking risks, unless that happens, a personal guarantee for every loan, I don't think is really doable. And nor is it desirable, because as I said, then very large projects will then not get taken. Who can take a risk of a few thousand crores? There will be nobody who will take those risks. And India today needs large projects as well. Yes, we need small value SME to pick up as well, but we also do need large value projects, especially because we are so short of infrastructure. So I don't think that will happen. But as for, making errant promoters pay, I think that is happening across the board. I don't see any reason why there should be doubts on that. And obviously, in any of these, if there is a haircut that the banks take, the equity obviously will have to get impacted. There are no two ways about it, and I don't think there should be any doubts on this matter, that this is something that will be definitely ensured when the banks go in for anything of this nature.
Is your sense that growth is picking up, at least, which will provide business to, say, steel companies, construction companies? Are you getting a sense that growth will solve part of the problem?
Overall, also, I think, though it is still a little patchy, but growth is sort of coming back. The reason why bank credit is not reflecting this is because today the commodity prices, the input prices are all pretty low. As a result, with the same bank credit, you are able to actually achieve better capacity utilization. Having said that, it is also a fact that unless capacity utilizations go above 75-77%, you will not see new investment coming in. In fact, unless it goes to 80%, I don't think new investment comes in. So to that extent, I think this time round, the growth will precede credit growth. So it will not be a credit growth-led growth. It will rather, credit growth will lag growth. And therefore, I do believe, yes, growth will come back in. The monsoon is a good trigger, and if that happens, rural demand should also become a little better. Urban demand has been sort of holding its own, but obviously it will get reinforced with rural demand. So we are hoping that, yes, growth will come back.
Okay. Yes,
and it will help.
Sorry, I just want to make a comment on growth.
It will help.
I think I fully agree. I think there are definitely signs of growth picking up. I agree that growth will precede credit growth, and I think retail credit is picking up as well. So I think consumption and demand is picking up. If you have good rains, I think the rural demand should pick up as well, and we are clearly seeing signs of volume pickup. Okay, not just a price pickup, which is great. So let's keep our fingers crossed on that.
Okay.
But I don't think it's going to be big enough to take care of the NPA problems, okay? So.
Well, we'll have to leave it at that, Mrs. Bhattacharya. Sanjay, thank you very much for joining me in this very useful and enlightening conversation. Well, what were the key takeaways? One, banks, government and private equity funds are pretty close to putting together one or maybe two funds to give working capital and another to give last mile funding to unfinished projects of stressed companies. Two, rules are in the making to take out the unsustainable debt of overpriced projects and ensure that both banks and promoters share the hit. Three, work is underway to constitute a committee comprising, some people of high integrity, high court judges or an ex-CVC official to vet the process of restructuring debt. Four, all these may be in place in a few weeks, and the first case of rescuing some of the companies may happen very quickly in 2 to 3 months. The fifth takeaway, and the most important, growth and monsoon may bring back some demand and rehabilitate some companies very soon. Short point, banks and stressed companies are not in the ICU. They are weak, but they are in convalescing stage. That's the key takeaway from this edition of Indianomics. Thanks for watching.